Hi, good evening, everyone, and welcome. We're all really glad to have you all here today. Whether you're joining us for the first time or you've attended one of our previous sessions, welcome back. My name is Avilash, and today we're going to talk about something that I genuinely feel is one of the most underutilized tools available to Indian investors right now, which are US listed ETFs. So, now we all have heard of the phrase not to put all our eggs in one basket, but I'm sure everyone has. How many of us have actually built a portfolio which reflects that? Because most of the investors that I speak to, they're concentrated either in one stock, one sector, or just one country, India. And today, we are going to change that. By the end of this session, you're going to understand how a single ETF can give you exposure to hundreds of companies across multiple sectors, across multiple geographies, all within one trade. So, sounds too good to be true. Let's get into it. Let's start with the basics. What is an ETF? The simplest definition I can give you is that an ETF is something which trades like a stock but holds a basket of securities inside it. Think about it this way: when you buy one share of Apple, you own the company. You you own one share of the company, but when you buy one ETF, say that one ETF is tracking the S&P 500, you essentially own a tiny slice of all the companies from one basket. Now, I would like to break down a few things which really makes ETF special. First is that it gives you access at a great scale. One ETF can give you exposure to hundreds, sometimes even a few thousand stocks. Instead of researching 50 companies individually, we can buy just one fund. Secondly, we can trade it anytime. Unlike mutual funds in India, where your NAV is calculated at the end of the day, ETFs trade live during market hours. If the market moves at 10 a.m., you can react at 10 a.m. Thirdly, it has much lower costs, and this is a big X factor. Mutual fund expense ratios in India can go up to 2.5%, while some of the best US ETFs charge as little as 0.03%. That is literally 3 basis points. And fourth, it gives you instant diversification. The moment you buy an ETF, you are diversified. You don't need to build that diversification stock by stock over months. So that is the foundation of how simple, low cost, diversified, and liquid a product which you are getting. Now, why should we choose ETFs? Now, a lot of you might be thinking, we already invest in mutual funds, so why do we need ETFs? That is a great question, and I would just like to walk through a comparison. We are looking at three options: individual stocks, mutual funds, and ETFs. Across three parameters: diversification, trading flexibility, and fees. When it comes to diversification, if we buy individual stocks, our diversification is very limited. We might own just 10, 15 stocks if we are a active trader. Mutual funds and ETFs both offer us high diversification, so that's a tie. But when it comes to trading flexibility, that is where the ETFs win over mutual funds. Individual stocks and ETFs you can buy and sell anytime during market hours. Mutual funds are only executed at the end of the day. If the market crashes at 11 a.m. and you want to move out to safety, with a mutual fund, you are stuck till waiting till the end of the day. And while individual stocks have no management fees, mutual funds tend to have very high expense ratios, and ETFs have significantly lower expense ratios. So, to summarize, ETF gives you the diversification of a mutual fund with the trading flexibility of a stock, and fees that are often a fraction of both. And to one more thing, the quote on the slide is something that I want us to remember: that funds that trade like stocks but hold a basket of securities. That one line is the entire ETF story. Now, coming to the power of ETFs, what does what are the factors which makes ETFs genuinely powerful beyond just our basics? It is global access. As an investor, we can be sitting in Bangalore, open the Borderless app, and invest in US ETFs, which gives us exposure to companies across US, Europe, Asia, and even emerging markets, all from one platform. It has a very low cost, as mentioned earlier. The expense ratio of some of the best ETFs are as low as 0.03%. To give us perspective, if you are investing 10 lakhs, we are just paying 300 rupees per year in fees, which is significantly lower to that of a mutual fund. ETFs have very high liquidity. We can trade it anytime during market hours. ETFs have full transparency. So every ETF has openly published what exactly it holds. Unlike some of the funds where we get quarterly disclosures, with ETFs, we always know at lifetime what are we owning. It offers easy diversification. This one speaks for itself. One purchase and your risk is spread across hundreds or even thousands of companies. And lastly, it offers a very simple start to our investing journey where we do not need to be rich to start. We can just begin with any amount that we are comfortable with. That is the power of ETFs. It is accessible, it is transparent, and it offers low cost global investing. So, coming to the next slide, what has changed in the ETF since our last webinar? Now, for those of you who attended our previous webinar, we already know the fundamentals. So let's see what has changed in the market till then. In August 2025, the total AUM in US listed ETFs were $12.25 trillion. By February, the number had jumped to $14.3 trillion. That is roughly $2 trillion in new money which has flowed into ETFs just over a period of few months. In August 2025, investors were putting in $117 billion per month on an average into ETFs. By February 2026, that number had grown to $197 billion. That is nearly almost $200 billion in 1 month alone. And we can see close to a 90%, 80 to 90% increase in a monthly AUM, which is flowing into the ETFs. And 74 new ETFs have launched since August 2025. By February 2026, that number was 93. The product innovation in this space is also accelerating at a great pace. This tells us that ETFs are not a very niche product anymore. They are becoming the dominant vehicle for global investing. Institutions, retail investors, pension funds, everyone is gradually moving towards ETFs. And as an Indian investors, now that we have access to US markets, we have a front row seat to this. Now, the ETFs are also getting bigger. And from here, we have seen February has a monthly inflow of $197 billion. Now, US ETFs alone in the last 12 months, if you break it down by categories, equity, fixed income, commodities, currency, asset allocation, and alternatives, you can see that ETFs are dominating this category. And they're also growing at a very steady, healthy pace. Now, we're heading to the next category where we are going to be talking about the different types of ETFs which we get. And I would also like to hand it over to Rohan, my co-host for the day, who will take us through the next part of our piece.
Yeah, thanks so much, Abhilash, for covering what are ETFs and giving an idea to the investors that how big the ETF market is. But I also want to just quickly touch upon this slide that Abhilash was talking about, that ETFs are getting bigger. But one thing to note is that every month since the last 12 months, we have been seeing in the US markets that new ETFs have been launching, and especially active ETFs. So active ETFs are basically ETFs that are more actively managed by a fund manager than rather than just replicating an index. Okay. So that is what we have been seeing. Uh, so this is where the US ETF market really shows its breadth. ETFs are no longer just about tracking a broad index market, like how we have known about it in the Indian markets. Like, you have basic things like, tracking the BSE or the banking index. But in the US, right, there's a lot more than just index. You can track sector specific. You have smart beta, which is a little bit more than passive investing. Then there's a thematic ETFs. Then there's inverse and leverage funds where it gives you a lot more strategies than a traditional investor can have access to. And you have also international exposure ETFs, which invest in different countries. And you have Bitcoin and cryptocurrency ETFs, which gives investors access to asset classes that are not traditionally available in a demat account. Then lastly, you have your bond ETFs. And over the next few slides, we'll briefly cover each of them with examples and news on each of them and how do you use it in your portfolio. To start with, index ETFs. So index ETFs are basically the foundation, right? And these are your core building products of your portfolio. For example, right, you want to be a part of the American dream. uh, you can just simply buy the Vanguard S&P 500 ETF and just be part of the American team. It's as simple as that. And what they do is they just basically mirror the S&P 500 index. There's no rocket science to it, so you can just quickly go on the Borderless app and you can just look at VOO, click on it, and just get the entire S&P 500, basically the American market, and be a part of the action. And who is it best for? It's best for people who are new. It's also best for people who have a eye for the US markets in the long term growth. And they are also core portfolio holding for major investors across the globe. The next types of ETF that we are going to be covering is sector specific ETFs. So these are very simple. They are basically targeted towards sectors like tech, sectors like healthcare, sectors like energy, financial. So let's just say right now we're going through a bull run of AI and tech, right? So you can look at a lot of examples of uh, ETFs that are basically just investing and focusing their investments towards tech. So whenever the next cycle of growth happens, for example, it will be healthcare, you can pivot your portfolio accordingly to a healthcare ETF simply with sector specific ETFs. And these are great for tactical allocation and experienced investors basically, trying to track the market, looking at momentum. These are great vehicles for investment. The next type of ETFs we're going to be talking about are the smart beta ETFs. So this is what I like to refer to as the secret sauce of investing, like rather than just having an ETF like an index ETF or a sector type of ETF, you can have a type of ETFs called smart beta ETFs that add a little bit of uh, tactical strategy to each of this to boost their performance up. And some of the more popular smart beta strategies include value tilting, growth focus, equal weight, low volatility, and quality factor. And we're going to talk about more of these in the next slides. To start off with, let's start with value tilting. So value tilting just means that it's focusing its allocation more towards value stocks. So Rohan, what does it mean? So let's take SPY. SPY is your broad market ETF, right? And there is an ETF that is a value focus of it. That's called the SPV. Now, if I were to zoom in, you can just see the allocation change, right? You're seeing more allocation in, for example, in SPY, you have more allocation in infotech. But whereas SPVY has a lower allocation in infotech, but has more allocation in financial and healthcare. Basically, it's mirroring index, but it's just changing the weightage of it to focus more on value. That's what it's doing. And the next one is your growth focus. Just like your value tilting, growth focus basically mirrors growing companies that are growing faster than your overall markets, right? To just zoom into this slide and to give a comparison, VOO, your standard S&P 500 ETF, right? The value version of it is the VOG. As you can see, right, the weightage of the stocks inside the ETF changes drastically. Like you are seeing a huge portion of weightage in Nvidia compared to VOO. You're seeing a more weightage of Microsoft in these kinds of ETFs compared to the standard index funds. So this gives you a little bit of more flexibility, a little bit of more uh, allocation in certain stocks that you prefer, but without you buying individual stocks. And this leads to higher returns in certain market conditions. The next one we're going to be talking about is equal weight ETFs. So equal weight ETFs are basically uh, gives importance to the same importance to every stock in an equal quantity, regardless of its company size or influence. So this method reduces concentration risk by avoiding overexposure to the largest companies, such as a big tech, for example, like an Nvidia, if you have seen the previous slide, or a banking giant, right? It also provides greater diversification, allowing smaller and mid-sized companies to contribute more to index returns compared to market cap weighted funds. And rebalancing in these type of ETFs typically are much higher, so it can result in a little bit more of a trading cost or a fee for you. And one thing to note about this equal weight ETFs is that performance may be stronger in certain market conditions compared to others. For example, right, like when smaller companies outperform large caps, but this type of ETFs can certainly lag during mega cap bull runs because of the equal weightage that it provides. The next smart beta ETF we're going to be talking about is the low volatility ETF. So low volatility ETF invests in stocks that fluctuate less in price, aiming to provide smoother, more stable returns over a period of time. Their aim is not to give you the highest return, but to maintain and give you stability over a period of time. So that, for example, like we are going through a Middle East crisis right now, right? These type of ETFs tend to shine during uncertain times in the market. The main benefit is that they reduce portfolio risk and help cushion losses during market downturns, making them more, like I mentioned, more valuable in volatile or uncertain conditions. And the peace of mind that investors get is that the portfolio benefits from less dramatic portfolio swings during market conditions. And uh, this type of ETFs are best meant for people who are trying to just be stable during turbulent periods of time, or it's for people who are very conservative or they don't have a huge risk appetite. These type of ETFs are very perfect for those people. Or if you're in your 50s, your late 50s, this is a type of ETF that's very good for people who are like close to their retirement because it can help you from a downturn. So the next smart beta ETF we're going to be talking about is the quality factor ETF. So quality factor ETFs basically invest in companies with strong fundamentals, high return on equity, stable earnings, and low debt. So these are in I'll just zoom into this so you can understand the kind of companies that are basically in these type of quality factor ETFs. So it contains companies like an Nvidia with good amount of earnings, Apple, Microsoft, Lilly, Visa, Mastercard. So why do people buy quality factor ETFs? So quality factor ETFs basically help investors manage their risk during volatile markets because they have historically outperformed downturns. So this is another ETF that a lot of investors look into investing in the US markets. And quality factor ETFs can be a part of a diversified smart beta ETF along with your index, along with your growth ETF or a value ETF. It gives you a little bit of an upside. Next, the next major type of ETF that we are going to be covering is your thematic ETFs. And these are the type of ETFs that all of us are really interested in. And you probably would have heard over the last 2, 3 years about, some of the hottest themes out there. For example, it can be on AI, it can be on robotics. And then we've also heard very fancy phrases like clean energy, sustainable investing. Then you also had a huge push for cybersecurity as well. And this is where thematic ETFs comes to solve your problem of what type of stocks are there, and let's just say in AI or robotics. So these type of ETFs make it super simple for investors to look into investing. And thematic ETFs are really built around long-term trends rather than broad market indexes. And these can be exciting products because they're often targeted towards coming trends, but they also tend to be more concentrated and more volatile than your other broader market ETFs. So just a point to note. And these are also very easy to invest in because let's just say that you are very convinced that, okay, AI is the theme for the next 1 to 2 years. You just have to find the right ETF for AI. Just click on it. You can see the holdings of that particular ETF and just buy it. It's simple diversification. And just to give a sense of what happened in 2025, right? So to backtrack a little, in 2022 to 2024, a lot of investors like moved out of thematic ETFs because they played it safe because markets had fallen and markets were recovering at that point of time. And then last year was the year of AI, right? A lot of money moved back into thematic ETFs. And just to give a note, last year in July, $4 billion went into ETFs, and it's the biggest inflow since 2021. So you can just imagine, like in thematic ETFs, like a lot of conviction has taken place, and a lot of investors just tend to buy this because it's much more easier for them to track. Next, we have something called the inverse and leverage ETFs. These are like really cool and very highly specialized ETFs and are very different standard long-term investing or short-term investing products. To get started, what is inverse ETF? So inverse ETFs are designed to move opposite to the market, right? So basically, let's just say you know that the market's going to fall today, right? Some news would have come up. You would have been very convinced on that. Now, a lot of people tend to lose money when the market falls. With inverse ETFs, you're able to make money when the market falls. Simple as that. And what are leverage ETFs? So leverage ETFs are basically, uh, uh, for example, I'll just give you an example. Let's just say you want to buy a stock of Nvidia. Nvidia goes up by 10%, right? In 1 week, and you just made 10%. Let's just say there is a way to double that investment or 1.5x that. So there are ETFs that basically give you a leverage of 1.5 or 2x that. So if Nvidia stock goes up by 10%, your stock makes 20%, your ETF makes 20%. So you have ETFs that are, for example, Granite Shares 2x Nvidia daily ETF that aims for 2x the daily return of Nvidia. So these type of ETFs are basically tactical tools for short-term traders, but they are not meant for long-term buy and hold investors. Okay. And the biggest warning that I need to give you guys is that there is a daily reset happens, and the compounding effects can lead to outcomes that surprise investors if they hold them for too long. I have a document on this, and I'll be sharing a lot more details on leverage ETFs with you after the webinar. An email will go out on that, so you can read more about it and understand what exactly it is and what is the math behind it. Because many people think that let's just say in a week I've made like 10%, I'll be making 20% on the leverage ETF, but it doesn't work like that. The reset happens on a daily basis, so you will sometimes make a little lower than that, or you might make slightly higher than that, depending on your daily reset. So post the webinar, I can give you a document on that highlighting the math behind it. The next main category of ETFs that we're coming to is Bitcoin and cryptocurrency ETF. And this is the main thing that has happened in the last few years is that entire new spectrum of ETFs that were created to bring in non-traditional assets such as cryptocurrency into the hands of traditional investors. And this is the biggest thing for investors like me and you because in India, right, if we had to buy cryptocurrency directly, we would be paying a lot in taxes when we want to sell it. Buying a crypto ETF just makes it so that you just have to pay it at a long term or a short term capital gains tax based on the equity class of it. So you end up saving a lot in taxes when you buy a crypto ETF than buying in the more traditional route. And why investors love crypto ETFs? Because they're super easy to buy. You can just buy them during market hours. You don't need to set up any wallets or private keys or open a completely different account for that. And over the course of the past few years, right, we have seen a lot of regulatory clarity and institutional grade security for these type of investments. So they are much more safer than what they used to be. International exposure ETFs. These are the type of ETFs that lets investors sitting in India invest in anywhere in the world with the help of international exposure ETFs that are listed in the US. For example, right, you want to invest in the Korean economy because in the last 1 year you would have seen the Korean index like go up, right, quite a lot. You're able to buy a Korean index ETF and in the benefits of the growth in that market. Or let's just say you want to buy a Vietnam economy, you can go ahead and buy an exposure into that by an ETF, or a Japan or a Europe. And it's very simple and it's a way to diversify even beyond US markets. Lastly, we're going to be talking about bond ETFs. So just like your regular bonds, the US also offers a lot of bonds in the US via ETFs. You can get a bunch of bonds in a single buy transaction, and you can also look into buying treasury bonds, US treasury bonds via ETFs, right? And you're also able to get different types of international bonds as well. And one of the reasons why bonds are super popular is that they allow for steady income, easy diversification, and portfolio stability. And investors can choose from short term treasuries, investment grade corporate bonds, high yield bonds, international bonds, and inflation linked bonds called PIPs in the US market. And most of these bonds are available on our platform as well. Uh, and the typical yield for some of these bonds range from 3 to 8%. But just to give a warning, yields vary by bond type, duration, and market conditions. Now, coming to how can ETFs help in volatile markets, right? We've just seen a lot of geopolitical tensions that happened in the last few months, and we've also seen the crisis that's developing in the Middle East. And I just wanted to show that even in March, right, how and where the ETFs, the money went into ETFs. So as you can see, right, 70 billion dollars went into equity ETFs. You've seen 50.8 billion dollars go into income ETFs, 3.6 into alternatives, 1.4 into asset allocation, 2.2 billion in currency, and 10.7 into commodities. That includes oil, gold, and your other classes. And this slide is especially relevant because it just shows that how ETFs are used in real market conditions and not just in theory, like what we had explained earlier. And in March 2026, right, the inflow of ETFs that went into the US markets were around $17.4 billion, a little bit of a dip, but people still had convictions on the ETF market and then they put it in. The biggest takeaway in this is that investors often rotate within the ETF ecosystem rather than exit the markets completely. So you're also seeing that's not mentioned here is there's also a rotation that took place in the ETF market as well. This is a really important slide. I just wanted to show our audience on how the top 15 ETFs that were traded by our investors in the last 1 year, right? And most of this data is almost the same since just few would have changed. I just wanted to show that, one of the biggest things that I was told was NVIDIA, right? NVIDIA people were like swarming for when the company was making a lot of money in 2024 and then 2025 as well. And a lot of investors started investing in the leverage ETF called NVDL. Then you also have your ProShares Ultra Pro Triple Q ETF. We have seen a lot of silver ETFs being bought. We have also seen IBIT, a form of crypto ETF being bought, and also a leverage ETF of crypto, BITX. We've also seen in the last 1 year people buying a lot of crude oil ETFs as commodity ETFs. Now, for a lot of investors, right, not every ETF is meant for every investor. But I just want to put this slide out to just help some new investors in our webinar today to get them to understand what kind of a mix of ETFs can I do to get started. And this is just an illustrative example. Of course, you can, read about it a little and you can connect with us and we can help you out to identify how do you start off with. But this is just like a guide, more so you can say that I've pulled out from the investor community and I've just put on this slide here. And the more advanced you go, you would add like more stuff like an inverse or a leverage ETF into your portfolio or a more thematic, more allocation to thematic. But for most of us to get started, right, for new investors, the biggest thing you can do is just buy the Vanguard S&P 500 ETF, and just buying that gets you into the American dream. Now, resources, right? This is something that I want to cover, and I actually have few resources that I want to show you. That these are resources that I use as well, and I'm going to be showing you a fourth resource that is a paid tool that you can look into if you are like a very seasoned investor looking to invest. I'm just going to share stop my yeah. So the first resource that I'm going to be sharing now right now is something called ETF.com. So ETF.com is a very powerful website where you can get a lot of news on the type of ETFs that are there. It has, for example, latest news, a lot of really good news, sort of topics on it, and it's a lot beginner friendly. And this tool also lets you screen ETFs. It also shows you the ETF fund flows as well. This is where a lot of my data comes from. And you can also try to understand like where uh, the money is actually coming from and moving out. So this gives you an idea on the ETF. The second tool that I want to share is something called ETFDB. Now, this is the holy grail for getting started. This contains all the types of ETFs that you want to understand and you want to find out, okay, this is the type of ETF for me. For example, right, we want to get into energy. So this lists all the types of energy ETFs that you can look into. And if you were to click any one of them, it gives you a detailed breakdown of everything that you require. It gives you a report as well, an analyst report. Uh, it tells you on the holdings. It tells you about the expense ratios and fees. And if the ETF gives you dividend, you can also find that out over here. And it's a really good tool for people to, screen their ETFs before buying, get to know more about their investment. And the last tool that I want to just share, there's one more tool that I had mentioned. It's Morningstar. So Morningstar is basically, uh, I'll come to that. This is another tool that I want to just show. It's called Seeking Alpha. So Seeking Alpha is like a paid tool that you guys can look into. It's a little of a pricey subscription, but not sure how much is it. You can go online and check it out. This gives you a more of a quant rating, or you want to look at buy, hold, or sell ratings, right? And you want to make your investing journey a lot more easier. This is a kind of tool that you can look into getting. So this tells me like the top ETFs, top rated ETFs, they're there with a strong buy rating. And if I were to just scroll down, you can just see the type of ETFs that are there. Let's just say I want to look at COPX, right? The copper miner ETFs. I want to know more about it in detail. So this gives me a much more detailed chart. It also tells me the ratings of it if I were to look into buying or selling. It also gives a lot of news and analyst reports on what their convictions are and if it's a good time for them, explaining to us if it's a good time to buy or sell or hold as well. And it also gives you a good amount of ratings as well on when you need to look into selling or buying. It's a good tool to have. And lastly, there is Morningstar. One second. So this is also another tool that gives a lot of ratings on ETFs. It's something that you can also look into. It's another free tool. But some of the features I believe are paid. But you can also look at, for example, news to get an idea of if it's a good time to look into buying an ETF or not. So there we have it. The three, basically four types of resources I've covered. If there's any questions, we like to take them right now. So if you have any questions, you can just raise your hand. Uh, I can just invite you to join. I'll enable the mic and you can just speak your question, or you can, if you're comfortable, you can just look into putting it in the chat. So there's a question from Commodore Ashwin. So Ashwin, I believe you would have received some communication from us that we are looking into expanding into other markets. You should be hearing about it soon, but it is going to take some time because there's a lot of regulatory hurdle around it. It's not something that's readily available in the market, especially for Indian investors. We're really working on it, and it's a really cool product that we're developing, and you'll hear more about it in the future. There's a question on how is this more different from stacks. Uh, So ETFs are quite big. They're traded during market hours, but as a stack, think of ETFs as being listed in the US stock exchange, whereas a stack, right? I'm not sure if you have heard this thing called a small case in India. A stack is basically mirroring a small case. It's basically a fund manager that you know and trust, uh, basically creating a portfolio for you, and you just buying that portfolio and getting a much more diversified portfolio compared to an ETF. An ETF alone will not solve all your portfolio needs. You would need to have multiple types of portfolios to have a complete uh, ETFs in a portfolio to make it more complete and to make it more diversified. A stack is more of a mix of stocks and ETFs to give you a more complete and a diversified portfolio based on your theme and your risk tolerance. Is there any other questions? So ETFs are already predefined based on the company that's basically managing them. You can't basically select the allocation of it. They are like already predefined. So basically, when the expense ratio is 0.39%, it's basically just adjusted in NAV. It's just a management fee of that ETF itself. So you're not paying anything extra from your pocket. It's just adjusted towards your total returns. So, in case you guys like this session, or if you would like to see something more on this, for example, we'll be having one next month on renewable energy and ESG investing through ETFs. You can look into that as well. We'll be sending out invite in that. And please don't forget to leave a review once the webinar ends. That'll help us out as well. Uh, so you can access fund houses through Borderless, but we don't actually have a category for you to select. If you were to just Google search the ticker of the fund house that you're looking at and the ETF that you want from that fund house, if you just put that ticker into our platform, you can definitely buy that ETF. Most of the ETFs that are available. It's just that there are few newer types of ETFs that won't be listed in our platform. That's because our partner in the US, our broker partner in the US, Tribal, needs to screen those ETFs to make sure that it's the right ETFs for our global audience. Uh, so there are absolutely no charges apart from the brokerage that you pay on the ETFs. So when you're buying or selling the quantity of ETF, that's the only time you end up paying a brokerage. Apart from that, the expense ratio is also there in the ETF, but that's usually adjusted in NAV. It's something that you don't consider most of the time because the expense ratio is much lower than a mutual fund. So is there any other last question that you'd like me to cover, answer? By the way, we're going to be having a webinar next month. Sorry, not next month, this month, and the topic is on, just give me 1 second. Investing in AI beyond the obvious. That's the topic this month on 29th. NVIDIA is already expensive. Here's where smart money is looking. Next in AI, we're going to be having two guest speakers from Shift All Cap, Anurag and Himanshu. I'm pretty sure both of you uh, have done, like both of them have done multiple webinars with us in the past. We're going to be covering a new series going forward. We're going to be covering the next type of investments that most people are not looking at, apart from your major companies like your Microsoft, NVIDIA. I'll be sharing the Luma link on this as well. Give me 1 second in the chat. Feel free to register for this. You'll get to see the invite happening after this webinar. So since there are no more questions, thank you all for joining. It's been a pleasure. If you've liked the webinar, please leave a feedback. If you have any questions after the session, you can drop me an email. My name is Rohan. I'm happy to help you. Uh, my email ID is rohan@stockle.com. Feel free to send me an email if you have any questions post this webinar. I'll also be sending out a link for the video recording along with the deck and the leverage ETF as well, along with the link to all the sources mentioned in the presentation. So thank you all for joining. Hope you have a great time. Have a good day.